Thanks. I always forget about that part. Thanks, Carrie. It's great to be with you all this afternoon. Thank you for joining us. Welcome to what is now our fourth quarter of reporting on the Engineering Business Sentiment Study. So we're excited to share with you results from that, as well as some macroeconomic information, some industry data. We want to give a shout out to our sponsors of the Institute who make this research possible. Without them, we would not be able to do what we're doing and provide that information back out to ACEC members and the industry at large. And thank you to those of you who complete the survey each quarter. Obviously, without your information and your input, we would not be able to do this as well. So I'm joined today by my colleague, Joe Bates, who serves as a research consultant to the Institute. And Joe and I are going to share some of these results with you. The full results are available now. And at the end of this presentation, there'll be a QR code on the screen that you can snap a shot of and get right to the report. But Joe, let's go ahead and get started and dive right in.
Great. Thanks, Daphne. And it's great to be here again with you all. Just another note for you, the presentation we're providing today will also be sent out to all of you who registered. So be sure to look for that email. And we conducted this survey in July, or right after the July 4th holiday. So this was in the field, sort of the last part of the first week of July and the whole second week of July. Just keep that in mind because there's some really interesting information and the timing of this information will, I think, surprise you as it did me. So today we're going to go over how is the economy doing. We're going to look at some of those macroeconomic trends that Daphne was referring to. Then we're going to get into how's the AE industry doing. We have some private market data that we're going to share with you. This is provided to us through the U.S. Bureau of Labor Statistics. And then we're going to get into what does the future hold? And this is where we'll talk most about the results of the survey, the sentiment survey that we conducted. So with that, we'll hop right into it. How is the economy doing right now? Now, hopefully none of you are laughing because it is somewhat of a loaded question here, but it's really interesting. When we look back over the last 4 or 5 years, we see that the economy did quite well, obviously, before the pandemic. Those very large bars that are negative and then positive in back-to-back quarters in 2020, that's the pandemic obviously hitting. And then we actually had very strong growth following the pandemic. A lot of money was being pushed into the economy, a lot of stimulus, the economy was getting back on track. And so things were going quite well. And then in the first quarter of this year, we actually were quite surprised by a decline of 1.6% in GDP. That was a big surprise to almost everyone. Now, a lot of that was actually due to companies not replenishing inventory. It was also due to a lot of imports coming back online that had not been online because from pandemic issues and supply chain issues. And when you have imports, that actually takes away from GDP because that money is going outside of the country instead of staying inside of the country. So that was a bit of a surprise, but it was somewhat explainable by certain factors. And then we got second quarter data, and it was also down by 0.9%. Now, this was a little bit more concerning because it wasn't just some of those pandemic issues and supply chain issues. What we saw was that there was, again, decreases in private inventory investment. So companies were just not replenishing their inventory at the same rate as they had been. Typically, that's an indicator that consumer spending might be slowing down or that the business are just concerned about having too much inventory on hand. We also saw declines in residential investments, so housing. Also, the federal government spending has declined in the second quarter, along with state and local spending. So we're seeing a lot of different areas started to decline in the second quarter. Now, is this cause for concern? Well, yes and no, because we're getting other conflicting indicators. So on the one hand here, we see employment. This is a very important statistic to watch because obviously when people are employed, they will still have money, even if there's a downturn in GDP. If consumers are spending, that's 2/3 of the economy, and that can help to keep the economy moving or at least stabilize it. So what's really interesting here is we've just about reached our pre-pandemic high in March of 22 of this year with about 159 million jobs. We lost about 26 million jobs during the pandemic, so it took a while for us to recover. But since that time, in the last 4 or 5 months now, we're seeing a flattening of the employment levels. And we still see a declining rate in terms of unemployment. It stabilized there for about 4 months. And then in July, we saw a downtick again of a 0.1%. So we are at more than full employment, but yet there are concerns about jobs.
So, Joe, quick question for you. I know in July, the report came out of 500,000 jobs were created, but you're showing only a couple 100,000. What's the disconnect there?
Yeah, so that's a really good question, Daphne, because the Bureau of Labor Statistics conducts quite a few different statistical analyses. This data we have here is based on what they call the employment survey or the establishment survey. So this is a survey of businesses. The other survey that gets the headlines is the household survey. So the household survey is showing that we had well over 500,000 jobs created in July, but the business survey shows only about 200,000 jobs. So there's a bit of a disconnect right now between these two surveys, and that's not typically the case. So again, we're getting some conflicting information here. I can't say that one survey is better than the other. They're just different methodologies. And so when you get different numbers, it kind of makes you go, well, we're not exactly sure what's going on here. But nonetheless, the unemployment rate is based on that household survey, and that ticked down to 3.5%. So we regardless of how you look at it, we're at full employment and people are working and people are still spending money. So that is a good news piece of the story.
Indeed.
Now, when we look at, and I apologize for the smallness of this, but this is actually diving into the data from the household survey. So the percent who are employed versus unemployed, who are in the labor force, et cetera. And the AE services falls in this professional and related occupations. Now, what we saw here was a 3% unemployment rate in July of 2022. That is still down from a year ago when it was at 3.9%. But what's interesting is when Aaron McLaughlin and I did this webinar about 3 months ago, that number was 1.7%. So now there is a lot of fluctuation when you get into these smaller sample sizes and sub-levels of the economy. But again, regardless of how you look at it, we are operating at full employment. Labor is still very tight, and even within our profession, based on what we're hearing from the Bureau of Labor Statistics. So this is a slide that I've been showing since we started this webinar and this series last year, because this is one that it shows me I'm still a bit concerned about what's happening in the labor market. The people ask, Joe, if we have so many people in the labor market, we've recovered from the pandemic, the employment levels are steady, why are we still having such difficulty finding and filling our jobs? Well, part of it is the unemployment rate is very low, but the other part of this is the labor force participation rate. So the unemployment rate is only based on those who are looking, seeking actively in the job market. This is the percentage of eligible workers, people who could be working, who are actively in the labor force. And you can see here that right before the pandemic, we were up at about 63.5 or 4%. And we obviously, a lot of people left the job force during the pandemic because of the shutdowns, and we've been clawing back since then, but we have not reached those pre-pandemic levels. And so we're at the 62.1% participation rate, and that's 1.3 percentage points below the participation rate from the pandemic. That's a lot of people who are still not in the labor force right now.
And, you know, Joe, I was just having this discussion with my daughter this weekend. It really begs the question, like, where did these people go, right? I mean, are they sitting at home? Obviously, unfortunately, we did lose some folks, you know, during the pandemic, quite a number of deaths. But how does this all tie together? Can you talk to that a little
Yeah.
bit?
So you can see, if you look back at the beginning of this table, this downward trend in the participation rate over time in the last decade or more. Well, that was the baby boomers retiring and not working. But then we started to recover a little bit as the millennials started to come back, you know, or were in the workforce in full force. And then we're pretty much at the tail end of baby boomers retiring. So what happened during the pandemic? We had obviously a lot of people drop out and not come back. A lot of working mothers have not come back. That's one aspect of it. People have taken early retirement. They have not come back. But as you said, Daphne, we lost a lot of people due to COVID. Now, if you have passed away, you're no longer eligible. You're not part of the labor force. So they're not
Sure.
in this anymore. But we did lose 1 million people, half of them of working age. So we lost a lot of workers. Right now, though, I did some research recently to help answer this question. I've seen estimates that range from 4 million at the low end up to 12 million people who are dealing with long COVID and are not able to work as a result. That makes a lot of sense to me as to why we are not having people in the labor force that we should have, because you would normally expect to reach that pre-pandemic level and continue to grow as the economy grows, as the labor force grows. But we have 4 to 10 or 12 million people who are sidelined. They would like to work, but they cannot. They're not even in the labor force right now because they are too sick to work.
Mm.
All right, so that's kind of in bad news. So we're going back and forth, good news, bad news, good news, bad news. And here's a little bit of good news, even though it's sort of, you know, we've had inflation problems this year. That everybody is aware of that. But we did see a downtick a little bit in July. So we had a June number of 9.1%, which was much higher than anyone anticipated. But then we got a downturn in those numbers to 8.5%. Now you can see that at different points in the last year or two, we have had some months or two where we went down or we went sideways. So we kind of are waiting. I think a lot of people are waiting here to see what's going on with the August numbers, which won't be released for probably another 3 weeks or so. But if this number starts to come back down in August, that is going to be a very, very good sign, because the Fed is intent on reining in inflation, you know, and this is rippling through the economy right now in all sorts of ways. So this is the most important thing that the federal government is working on right now. And it's great news that at least for a month, we had a decline. Now we need to see month over month decline so we can get inflation under control. All right, so what's interesting is we conducted our sentiment survey in early to mid-July. The July inflation numbers, keep in mind, did not come out until about a week or so ago. So what we see here are the ratings of inflation, the concern about inflation from AE firm executives before we got that latest reading. So just keep that in mind. Now, we asked, how concerned are you about the impact inflation will have on your firm in the coming year? We still have a very high percentage. 82% of respondents said, I'm concerned about this, or I agree with this statement. That's very high. And when we subtract our agree from the disagree, that's how we get our net rating. We really use this net rating as our metric over time because it balances out the percentage who are agreeing or who are positive about our questions versus those who are negative, and those can grow and shrink over time. So that net rating gives us a better metric over time. Now, what we also see, we asked this question for the first time: I'm extremely concerned that inflation will lessen or negate the positive impact of the IIJA. 79% agree with that statement, and we have a net rating of plus 69. Now, in this case, a positive number is not what you want to see. You want to see the opposite of that here. So we have serious inflation concerns still. But what's really interesting, again, keep in mind this survey was conducted in early July. At that point in time, the concern has started to come down just a little bit. It's still very high, but when you look at the prior quarter in Q2, it was at the net rating was plus 85%. You pretty much can't get higher than a plus 90 in reality. So the fact that this came down in July and is mirroring actual inflation numbers, that's a really interesting sign to me. It's very helpful to know that our data is tracking right now with those macroeconomic data. So this is really helpful information to have.
Well, and Joe, to your point, if you could just go back to that one, this is one of those where we do want to see the positive coming down, right? It's sort of counterintuitive to most of our sentiment survey where we want to see the plus number getting higher. But in this case, we do really want to see that coming down and showing less concern. And Joe, we actually have a question that came in. So if interest rates are up to combat the inflation, what will happen in the next 6 months related to this?
Yeah. So very good question. And my next slides will actually address this issue. Okay. So the Federal Reserve, again, is very much concerned about inflation. And so we have gone from a 0.25% federal funds rate at the beginning of this year, and it had been at that rate for almost a decade. And we have seen two significant increases in the federal funds rate. Each time in June and July, it was raised by 0.75%. So we are now at 2.5%, which is still extremely low by historical standards. Now, what we're hearing from some of the Fed governors, and these are those who are voting members of the Federal Open Market Committee, is that they want to see it at 4% by the end of the year. So even though we're seeing a potential moderation in inflation in last month, the Fed is saying we're not done. We are not even close to done. And this is just for this year. Now, I personally, this is just me, but I think they did wait too long to start raising those rates. So they have to be very aggressive this year. So I think you're going to see in the September meeting right now, the odds, if you look at the odds out there from the financial analysts, it's about 50-50 whether they'll go with a 0.5% increase or a 0.75% increase. Personally, I think they're going to be more aggressive here. I think they might go with the 0.75. That's my prediction. So let's see what happens. But what does this mean for inflation for the rest of the year? Again, I think if the Fed is aggressive enough, I do think we're going to see that inflation moderate. I think we're going to see it start to come down by the end of the year. But the concern is what type of impact will that have already wrought on the economy going into 2023? I think that's the real concern right now. And as I think most everyone knows, when the Fed starts to increase their overnight rates or the federal fund rates, we see an increase in mortgage rates. So this is the real number that you and I can relate to in terms of how is the Fed acting. Well, we're seeing that these rates were, again, at historic lows. I refinanced my house at 2.5%, right at the bottom there. And I got very lucky because now it's shot up. You know, these are monthly averages in the 30-year fixed mortgage rate. And so we did come down in July on that number as well, which again is a welcome sign. But again, if you look at the historical average, we're not even back to levels we saw prior to the Great Recession. We're just at the bottom of those levels. So again, the Fed feels like, hey, we have room to increase the interest rates. We have more than full employment. So let's take the time right now to get our interest rates back where we feel they should be for the long term. And then if we have a more significant recession, they'll be in a better position to lower those interest rates and get back to a more normal cycle. So I hope that answers the question, but again, I do think we're going to see a decline in our interest rates. I'm sorry, an increase in the interest rates. We'll continue to see an increase in those 30-year mortgage rates, although I think there'll be some ups and downs. And one other fact that I just read yesterday that shows that these interest rates are having the desired effect, whether or not, you might agree or not. If you're looking for a home right now, it's obviously a little more expensive, but from a macroeconomic point of view, we have in June and July, we have seen a decline in existing home sales year over year of 20%. That is significant, but we're at astronomically high levels. So it's a welcome sign. It's actually good that that housing market is cooling off right now. All right, I'll just pause for a second. Just Daphne, do you have any other questions at the moment before we head into how is the AE industry doing?
No, I just had that one, but it is a good reminder. If you have any questions, please put them in the chat and we'll get them in front of Joe as quickly as possible.
Okay, great. So we're going to move on now. Again, we're seeing high inflation numbers, but hopefully we're starting to get on top of that. The Fed is going to be very aggressive. We're going to see mortgage rates continue to rise, but we're going to see, I think, the labor market cool off a little bit. I think we're going to see the housing market is already cooling off, so that's good. I think, if the Fed can manage things properly, they'll get inflation under control without tripping us into a recession. But that's the big question. So how is the AE industry doing? Well, this is quarter over quarter. This is actually the same slide as we presented to you all in the last quarter, but that's because we haven't gotten Q2 numbers yet. Those numbers are going to come out in September. So we'll keep an eye out for those. And we are sending emails out about private market data. So keep your eye out for the September release. But what we're seeing is AE revenue, firm revenues, and this is based on the US Census Bureau data. We are continuing to see healthy quarter over quarter increases. I'm really interested to see what we see in Q2, whether we continue to see solid firm growth in revenues or whether we start to see a little bit of a leveling off. That's going to be the real critical number to watch in September. So keep your eye on that. But nonetheless, we're seeing continued quarter over quarter growth since we had the pandemic. And now this slide is annual. So we're not going to get an update on this slide until, early next year, probably late first quarter. But you can see in 2021, AE firm revenues jumped dramatically from 2020, and which was, of course, the pandemic year. So, we're looking good from what we can see from the macroeconomic data. And now I want to turn to some more of the sentiment data because we're starting to get, we have 4 quarters worth of data now. So one more quarter and we'll really be able to see year over year. And I think we're going to start to be able to make some comparisons to this other macroeconomic data and see how good of a predictor this survey data is. So the first thing you're going to notice on the left-hand side of your screen is we have continued to see since the fourth quarter of last year, the U.S. economy as perceived by those within the AE industry, those 600 firm executives that we survey every quarter, the U.S. economy perceptions is getting worse and worse. Now we just flipped in this quarter to negative overall sentiment of the current economic situation in this country. So that's kind of a watershed for us in this survey. But one thing you'll notice here is that when it comes to sentiment regarding the industry, which is in the middle, and sentiment regarding firms' overall finances, we've remained stable. And that is very, very good news.
Joe, to what do you attribute that good news?
So I think there's two things. There's probably more than two things, but in my mind, there's two main issues. One is that we see from even the Census Bureau data that the industry is still doing quite well. And so we're having this inertia that is perpetuating itself within the AE industry. You know, the recovery from the pandemic is solid. The second piece is the IIJA. In a survey we conducted last quarter, 23% of firms, almost a quarter, had said last quarter that they were already seeing benefits to their firm from IIJA infrastructure spending. And most of the other firms at that time said they felt like they would see benefits within the next 6 months or so. That is obviously helping to underpin what we see in terms of the economy, the AE services, as well as the firm's finances.
Now, the question is whether we are going to have the people to get all that work done, right? And I know you're going to address that a little bit later on, but so this is good news, and we'll keep moving.
Yeah, it's very good news because, again, we've seen this sort of progressive reduction in perceptions of the U.S. economy, but we're not seeing that yet within our industry. So that is good news. Now, when we look at some of this private market data, again, this is from the U.S. Census Bureau. This is specific to our industry. It's construction put in place, which is, again, a good indicator of how the industry is doing. We see year over year, June 2022 to June 2021, we see year over year total construction put in place increased by 8.3%. Very solid numbers. Residential was leading that with an increase of 15.6%. Private non-residential, it was a little slower at 1.7%. We see public spending really didn't grow as much. And as I said earlier, in GDP numbers, we're starting to see that just overall government spending is starting to soften. Now on the next slide, this is again US Census Bureau data. It's from June, and what we're seeing is the hot markets right now, year over year, keep that in mind, year over year, manufacturing is up 22.5%. Residential and commercial are still leading in terms of year over year. Conservation and development and sewage and wastewater disposal are also still the most positive year over year areas. Now, what's lagging? Well, public safety, lodging, religious, power, and transportation, but not including highway and street. That's just, again, that's how the Census Bureau has defined it.
Joe, so this looks similar to last quarter. Are there any differences here, or is it in fact kind of what we're seeing?
Yeah, so that's a really good question, Daphne, because as I was updating this slide, the last time we presented was in April, and we had April data here. So these are pretty much the same areas of construction that are doing better year over year, and the same areas doing worse year over year. But these percentages are moderating. So all of these numbers on the plus side have come down, and I expect to continue to see them come down, especially from what we're now seeing and hearing in terms of the residential market for real estate. In terms of the negatives, those are less negative. So we're also seeing a moderation on both the positive and the negative side. So I think we're going to start to see over the coming 6 months, when we start getting year over year data that's from the end of last year, I think we're going to start to see some changes in these what's hot and what's not areas.
Well, and I think on the next slide, you can show us what our firm exec thinks are what's hot and what's not, right?
Exactly, Daphne. Good segue there, because this is, again, current sentiment versus prior quarters by sector. And of course, our sectors don't match up exactly with what the US Census Bureau has put out as definitions. So I actually like to see the data we're collecting. What's really interesting here, there's quite a few things to unpack. The blue circles are the areas with the highest net rating sentiment in Q3 of 2022. So we see transportation for roads and bridges. We see transportation at airports. We see water and wastewater, and healthcare facilities are all at the top in terms of their current net ratings. And if you look at the other net ratings, they're still very, very positive. Now, yes, the downside is that most of these sectors, the sentiment has declined versus last quarter. And where has it declined the most? Commercial real estate, residential land development. So that's why I'm saying those year-over-year numbers that we saw from the US Census Bureau, I think we're getting an insight right now from our member firms as to what's happening in those sectors today. So we're definitely seeing a softening in those sectors. Again, it's not surprising given some of the other macroeconomic data, but overall, we're still very positive. The sentiment is still quite strong. All of these are above 40%, except justice. So that very, very strong, healthy economy for the industry at this moment.
It'll be interesting too, Joe, over the coming quarters of this, now that we have a full year behind us, right? We've got some trending from our executives within our firms, and now we'll be able to go back and look and see how much of a leading indicator, if any, our firm execs are to what's actually happening against the real data.
That's the gold standard here, right, Daphne? That we're going to know next quarter. We'll have true year-over-year quarters at that point in time, and we already see that hint of a trend where we're getting real-time advanced information on that inflation front. The firm consensus was that it was a little less concerning in July than it was previously, and in fact, when we got July numbers 3 weeks later, inflation numbers came down. So it'll be really interesting to see how this is going to trend with those macroeconomic data, and to see if we truly are predicting what's going to happen. So another piece of good news within the industry is that median firm backlog stands at 12 months. This is really good. And we see that the majority of firms report that they have backlog of 1 year or more. So this is really good news. And on the next slide, we see the median trend over the last year. And again, to move the median even 1 month, that means you have to have really positive momentum. So we see that the median has gone from 10 to 12 months in the last 6 months or so. And so that's really good news. It's a very strong indicator of a healthy industry right now. Now, let's get to the jobs, okay? This is where I think a lot of people really want to get a bit more insight. What's happening on the job front? Well, we see that the median number of open positions at firms actually decreased slightly in the last quarter. This is good news. We have such a tight labor market right now that we need to see, an easing of the labor conditions. And so we want to see right now these numbers go down. And the other aspect of this and in the full report, we have a lot of slides that detail geographic numbers and trends, as well as trends by firm size. So I encourage you to read that report, because what we're seeing here is that the largest firms, those with 500 FTE or more, they still have a huge number of openings. The median opening increased just slightly from 97 to 100 openings. And this has gone up from, I think it was at 60 in the fourth quarter of last year. So it's good to see that we're starting to potentially level off here, at least quarter over quarter. And we want to see these median number of openings go down, and the quicker the better. Now, we asked a new question in this most recent quarter. Why are you hiring? We know that 9 out of 10 firms have openings. We know that everybody is searching and struggling for talent. But why are you hiring? Is it because you're growing, or is it because of the Great Resignation and we have all this turnover in positions? Well, the news is both. So firms are being hit with a double whammy right now. We see 78% of respondents said their firm is hiring to accommodate growth, which is fantastic. I mean, that's really good news. But we have 60% of firms who say we're just trying to replace people who have left the organization. So this is a double whammy right now.
And Joe, that we know when we reviewed this report last week and you shared this with me, my immediate question was, how many are dealing with both? And I think you've got that number and you've went back and added it into the report. Can you report on that a little bit?
Yeah, that's what truly makes this a double whammy, Daphne, is that 47% of firms said that they're both trying to grow and hire new positions and replace people who have left the organization. So it really is a double whammy. I don't use that word lightly, although it's to add a little levity to our presentation, but truly half of firms are struggling with both. And that's a lot of firms. All right. What other effects are the hiring challenges having, the workforce challenges having? Well, we asked this question for the first time as well. What in the past 3 months has your firm turned down work specifically due to workforce shortages? And we saw that 52% of our respondents said their firm has turned down work because they just don't have the people. Now, I've talked anecdotally to a few of our AE firms here, and I'm hearing, just again, totally anecdotally, that some firms are saying, it's allowing us to be a little choosier right now. And that's not necessarily a bad thing. But nobody really wants to turn down work. I think everybody would like to take all the work they can possibly get. So, this is possibly a good news, bad news story, but some firms, I think, are looking at this as an opportunity to perhaps take work that might be more advantageous and more profitable to their business.
Yeah, and I think, Joe, next quarter, this is an area for us to dig into a little bit and figure out the exact whys. And in fact, we have a question came up too that's sort of tied to this discussion. So curious if the tight labor market is the reason backlog has increased, as in the same amount of work for less people and not an actual increase in work. So I think that's another valid point. And a lot of these things are tied together, right?
Yeah, and we can't answer that question with the data we have at the moment, but from questions like this, it helps us to formulate questions for the next survey. So that's a great idea to dive into that a little bit more.
Yeah.
All right. So that's sort of where we are right now. Again, overall, the industry is holding up. There are still very tight labor markets here. Firms are still under pressure. They're having challenges filling those positions for both growth reasons as well as turnover. But nonetheless, the current situation for the industry is good. Excuse me. And the question is, what does the future hold? This is perhaps the million-dollar question. So we're going to just review. This is data that we've had now for almost a year. So we just want to remind you that this was our forecast that we put out last year, which showed an increase of an annual year-over-year increase of about 5.6% in terms of AE economic activity. So this is a growth forecast from 2021 through 2026. 2021, because we didn't have final numbers, of course, at the end of last year for 2021. So we're going to see what happens. Now, the other thing to note on this slide is this forecast was actually compiled prior to passage of the IIJA. Right. So what we did was a subsequent analysis to say, if the IIJA is to pass, what effect might that have? So we see really strong growth because of that. And And this would necessitate an additional 82,000 jobs is what we predicted. So already during a tight labor market, we're anticipating even more jobs being needed to fulfill all of the IIJA work that's out there. So this is again, it's getting a little bit dated, but Daphne, I think you have an announcement to make.
Yeah, thanks, Joe. We actually are working on the update to this. And so the updated economic impact as well as the 5-year forecast will be released at the fall conference in October, ACEC fall conference in Colorado. So hope you'll join us for that. We'll obviously have lots of announcements coming out as that rolls out, but we will have a session to share with you the updated forecast then.
Yeah. And you may be wondering, okay, we've had a lot of inflation over the last, 12 months or so. And does this take into consideration inflation as well? Well, these are in real current dollars. So one of the things we're going to be looking at with our new forecast is how is inflation going to impact these numbers? And we'll see what's happened over the last year and even the year prior. So we'll start getting some insight into that, but we're going to have to see what the forecast model looks like when we plug in these inflationary numbers that we just did not anticipate a year ago. We also wanted to remind you, this is what the IIJA spending by market sector looks like. This is the actual passage of the bill. And we can see that almost $300 billion here is going to be spent in transportation. So the fact that we are currently seeing a strong transportation sector is not surprising at all. I think the question is, how does that play out over the coming year? And we're going to show you that in a few minutes with our forward-looking sentiment. Okay, so economic conditions 12 months from now. This is what firm executives are feeling will happen in the next 12 months. We see that the condition of the US economy has a net rating of -40. So remember earlier, we're currently at a -15. So just looking at that, you see, okay, looks like we're heading in the wrong direction. But we also see the condition of the firm's overall finances are still positive at a +29. Again, this is forward looking, what firms are anticipating 12 months from now. But the industry overall is just barely positive at +11 in our net ratings here. So how is this tracking? Well, this is the really interesting slide. If I had one slide to pull out of this whole deck, it would be this one. What we've seen is future looking sentiment for the US economy has been going down. And we saw a huge dip in Q2 of this year. And then our new number shows a continued decline. So a year ago, in the fourth quarter of last year, we were still barely positive looking ahead 12 months. And obviously, if you look at the current sentiment for the US economy, it's already negative. So I think we're going downhill with the economy's sentiment much faster than we had thought. But the real interesting point is, now we're seeing some potential weakness in the industry as well as firm finances. So that big decline in overall economy sentiment looking out 12 months was very much mirrored in the industry. So this is where the big question is. Now that in fourth quarter, we're going to have a year out, will we actually see current sentiment decline in the next quarter as has been predicted a year ago? Or is it more of a, we're doing fine. Actually, we're doing just fine right now. We're just concerned about the future. So are these concerns unfounded or will they be realized? I think that's the real question we have coming from this slide.
And I worry about this a little bit, Joe, of self-fulfilling prophecy, right? And it's interesting to me that each quarter we ask, how are you feeling now? And everyone's saying, firms doing great, industry's doing great, US economy, we sort of understand, right? So every quarter we ask that, but then when we ask 12 months forward, there's concern. And every quarter the concern's getting stronger, but yet the current is good and staying flat, right? So it's a little disjointed. And I think it'll be interesting to see where we end up next quarter. But I am concerned about that self-fulfilling prophecy a little bit.
Yeah, I am too, Daphne. I think you hit the nail on the head there, because this has happened before. Not necessarily, we don't know particularly in this industry, but we've seen it before in terms of recessions, that people start to think there's going to be a recession, and therefore they start to pull back on spending. In terms of the industry, we could see firms getting more hesitant to hire, firms getting more reluctant to expand their business, even if they think, well, it looks like IIJA is going to keep us up and afloat, but there's that question mark. And what does that question mark mean in terms of real activity? So, I'm not sure what we're going to see next quarter, but I'm very interested to see what happens. And we will, of course, be presenting this data at Fall Conference. So just a little plug for Fall Conference for you folks, but we'll see what happens. But it is true that we might be in a situation where it's a potential self-fulfilling prophecy. My hope is that it doesn't happen. My hope is everyone realizes, okay, we've been thinking something bad will happen for the last year. Nothing bad is happening. Perhaps future perceptions will start to rebound here.
And we do have another question, Joe, from our viewers. Have you started to look at the Inflation Reduction Act impacts?
So we have not yet done that, but the forecast that we're coming out with will definitely have that baked into it. So our economists are looking at that and working on that as we speak. So I can't answer that question right now, but we're looking at it. And again, at Fall Conference, we'll have more information for you. Okay, so this quarter, we also asked a new question. It was an open-ended question. Why did you provide the ratings that you provided on that previous question that we just looked at? Because we wanted to get some insight as to why people's perceptions were falling. We had a sense they would decline again, so we asked this question to give us a little bit more insight. So the top item here, and this is general economic uncertainty. Well, we've kind of already talked about that, so that doesn't surprise me at all. Slow application of the IIJA. This is something I've heard anecdotally, but we saw that this popped up as a main issue, as a theme here. Increasing interest rates. That doesn't surprise me at all either. Inflation and rising costs, that kind of dovetails with the interest rate issue. Supply chain issues, we've been experiencing those for a while, as well as qualified labor shortages. So, most of these are things that we've already been hearing anecdotally, but we were able to quantify that, yes, in fact, these are the main issues that are sort of pulling down those ratings for the future 12-month outlook.
Joe, when you look at this chart, it looks as though these all sort of are equally weighted or equal concern. Is that the case, or some, kind of a higher concern than others? Do you have any insight in that piece of it?
Yeah. So this was an open-ended question, which means we rely on people typing in information. About half of the respondents don't bother to do that. And so this data is based on the half that do. So we don't actually like to put numbers on these circles here. But what it tells us qualitatively is that these are the major themes that are out there in terms of concern. Now, what we can do next quarter is take these pieces of information and ask it in a quantifiable manner so that we can see, are some of these concerns bigger than others or not? So that's the more information we'll have for you at Fall Conference.
Good. I just made a note of that, so we'll make sure to do that for next quarter.
Absolutely. Okay, so we didn't go into regional issues and firm size issues in other questions. But again, we have a lot of these types of slides in the full report that can really help you to look at, well, my firm is, 20 people. So what's going on with other firms my size? look at the full report, and all of this data is in there for you. We really, unfortunately, don't have time to dive into all those details in this presentation, but I wanted to show you one snapshot here. What we see here, this is just focusing on the engineering and design services industry, future-looking sentiment, and this is, as we said, what we've been looking at for the last 4 quarters. So we've seen a big decline between Q1 and Q2 in terms of sentiment. It's still positive, but it is declining. Well, let's look at what's happening by firm size. What we see, just as a note, regionally, we see ups and downs. We see a lot of variation. It's hard to get a sense of trends when you look at the regions, although I think it is helpful just to look at the current numbers. But with firm size, we definitely see trends that have emerged throughout the last year when we've been conducting this analysis in each of the last 4 quarters. What we see here is that smaller firms are generally less positive, and this applies to pretty much every question we've asked. Of course, their backlogs are smaller just because they're smaller firms in nature, but they're generally less positive. And we see that here. We're just barely above break-even point now in terms of small firm sentiment looking forward. But we still do see positive sentiment as you go up firm size. So larger firms tend to be more positive. Smaller firms tend to be less positive. I think what's going to be interesting is what happens in the next quarter, because what we've seen from all of the research we've conducted since the pandemic research that we started is that the smaller firms were hit hardest, they were hit first, and they were the last to recover. So I call the small firms the canary in the coal mine. And right now we're seeing that small firms are telling us we're just barely looking at breaking even in terms of our future sentiment 12 months from now. So that's what I'm going to look at next quarter, is not just the overall number, but what is happening with these small firms, and do they go negative on future sentiment next quarter. Okay, so looking at the sector level data, again, 12 months out, what's the perception of what's going to happen at each of these levels? Now, you see that these numbers are all much lower than current numbers. So our top numbers in the blue circles are at plus 55 for transportation, plus 46, roads and bridges, that is, and plus 46 for transit. Airports is at plus 38, water and wastewater is at plus 37. Again, these are all IIJA related. And in fact, that is the best we see here for 12 months out. But we see a lot of other sectors, especially commercial and residential, they are very negative now. They declined substantially in the last quarter, which is that far right column, and they are solidly in negative territory. So again, we're going to see in the next quarter or two what happens with the actual current sentiment and compare that to what we saw about a year ago. Anticipated backlog. Well, we told you that as of now, backlog has been increasing, but anticipation of backlog 12 months from now is softening. We're still seeing positive numbers, so a net rating of plus 21, which means that more firms feel like their backlog will increase than decrease, but we're not nearly as strong as we were just 2 quarters ago at a plus 56. So this is another one where I'm a bit concerned what actually will happen. So we're going to keep our eye on what happens with current backlog over the next few quarters.
And this is another one, Joe, right, where the future looking is coming down, but the current is slightly increasing. So a bit of a dichotomy there.
Yeah, very much. But that's why we ask these future looking questions. And again, we'll see whether these predictions that people made a year ago are going to come true a year out from that point in time, which will be next quarter. All right, what about hiring? Well, hiring, we still see very strong expectations in the future. Looking at very strong growth. 65% of our respondents say that their firm, they think there'll be an increase in hiring over the next 12 months. But the good news is that that is softening. Last quarter, it was 73%. In Q1, it was 80%. So this is actually where, again, we want to see that net rating, which is at a plus 59. We want to see that come down because right now it's just too high. You know, if we can get more in the plus 20, plus 30, I think we're going to start to see a lot of easing of the hiring challenges that we're seeing right now. This does again show the regional as well as firm size breakouts for hiring, anticipated hiring over the next year. So again, all firm sizes are still positive. That's the good news. Most are coming down, which again, that's good news. But again, look at that 1 to 25 FTE firm size. I like actually seeing that we're holding steady here, if not maybe improving a little bit over last quarter in terms of hiring perceptions, because again, you'll see that those smaller firms have lower expectations overall than the larger firms. And so I'm encouraged to see that that's leveling off right now. If all the firms can get to that point again in the 20s or 30s, I think we'll be in much, much better shape. All right, so what's next? Well, I've shared with you the data I have today. We have a couple minutes left. I'm happy to answer any questions that have come up. But just to recap here, unemployment still at record lows. Buying power is still strong. The consumer spending is holding up right now, although we're seeing an increase in inflation, but we hope to see that that's going to moderate a little bit in the next few months. Especially by the end of the year, we'll know the full picture, I think, of what's going to happen with inflation. Housing market is softening. We need it to soften. We just don't want it to go in a full-blown recession, but we'll have to keep an eye out on what happens there. I also read yesterday that for the first time we saw that, I think it was Zillow has shown a decline year over year of the median house price to purchase price. It was a decline of $400, so it's really not that significant, but it was the first decline they had noted since the Great Recession. So we are seeing that softening. And then what's going to happen? Are we going to have a recession in Q1 of 2023? Well, technically GDP has been negative for 2 quarters, but we're not in a real recession at the moment. So what's going to happen? We're still not quite sure. And we will have more information and things will become more clear over the next quarter or 2. Daphne, any other last minute questions?
I haven't seen any other questions come in, but I did want to just take a minute to remind everyone that, again, at the fall conference on the opening general session on Monday, October 17th, we will be unveiling the economic impact study that is going to be released by state. So our state member organizations will have a lot of great data that they can take to their state houses to show the value of engineering in their state. That will include number of jobs, wages, impact on GDP at the state level, the federal level. So there'll be a lot of great data coming out of that, as well as the new 5-year forecast. So that will be at that opening general session. We'll look forward to sharing that with you. Again, just want to thank our sponsors who make all of this research possible. We would not be able to do it without you. And with those of you on the line who have completed the survey, thank you very much. For those who haven't, please look for the next one that will be coming out for Q4. We would love to have your input. And finally, here's the QR code I mentioned at the beginning of our session. And if you just point your phone to that and click on it, it will take you to this Q3 report. As Joe said, there are a number of additional data points and charts and graphs in there, breakdowns that you might find interesting. So encourage you to take a look at the full report as well. Thank you so much for joining us, and we look forward to seeing you next time.
All right. Bye-bye, everybody.
Thanks, Joe.